Hello everyone, welcome back to Desires Certification on Advanced Financial Modeling. In our last session, we discussed how to forecast the revenue by dividing it in small parts in different segments and forecasting the billing rate and the number of employees billed. Today we'll look at the complete income statement, we'll forecast the cost line items and we'll make the complete forecasted income statement. Let's go to the content page, and as in the model assumption, we have forecasted onshore as well as on-site as well as offshore drivers in one sheet only. We can delete this sheet, delete, and we'll remove this row from content page. Now let's go to the output consolidated profit and loss statement. We'll make this consolidated P&L using the revenue we forecasted in our last session and the cost assumption. So we'll first copy the format from the historical income statement, which is we'll forecast till here to consolidated profit and loss statement. To make let's enable the content. To make the formatting consistent, we would be using Times New Roman. For the top row, we would use 14 font, blue background, and white the text of the color. We'll insert a row here. We'll write USD million. Okay. We'll go back to the historical income statement and we'll copy the yes, we'll copy till here. So we have this Q on Q number. We can directly link this number to the historical income statement. Okay. Now we have copied everything, but we need to copy the formatting also. So what we are gonna do, so we'll copy the format, great. So this is a Q&Q growth. All the Q&Q growth number will make it a blue color, and will make them percentage up to 1 decimal point. This is again blue color, percentage 1 decimal point, blue color, percentage 1 decimal point. This is great. So now we need we'll expand this revenue drivers. We need to take the forecasted revenue from the revenue drivers. First we would be using we'll just link this, or we can just go here and will space special. Will link the revenue. An important point to note here is that we should not copy and paste the any number in the Excel sheet. We should avoid hard coding the number as much as possible. This will actually make us easy, because if we change the number anywhere, if we are linking the output to the revenue drivers, if we are making any changes in the revenue drivers, it will automatically get reflected in the output. If we don't link it, we'll have to manually change it everywhere, which is going to be a tedious process because we are dealing with a lot of data here. So we'll link it. And we'll link the Q&Q growth. Great. Now we'll go to the revenue drivers. We need FY14. This is 15, 16, 17 and 18. So we'll make it 15, 16, 17 and 18. Let's group this data. Let's use the same formatting. Delete all the columns after that. Great. So we'll link this revenue line item from the historical FY14 would be, we'll go to the revenue drivers. This is FY14, revenue driver 15, FY16, 17, and the last would be FY18. So now we have linked the revenue we forecasted in our last session to the output sheet. We can calculate this Q&Q growth number. So we have the Q&Q growth number as well. We'll insert a row here. So this is the gross profit. Now to forecast the cost of goods sold, let's remove this line. Right. So to forecast the cost of goods sold, so there is one way. If had we given details of the cost, how much of the salary we are paying to the people on site, employees on site, and how much of salary we are paying to the people off site, we could have made the similar cost forecast. We could have gone into much more detail as we went in case of revenue, because we had the breakup between the on-site and the offshore revenue. But in case of cost, we won't have this information available through the public sources. This is one benefit of running a M&A process, because when you are running a process, M&A process for a client, you would be given a lot of information through the company, through your client only, and you can make a much detailed and precise model. But in this case, what we will do, will forecast the cost of goods sold as a percentage of revenue. Percentage of revenue. We'll make this red in color because this is something we are going to forecast. Bold italic. Excuse me. So what we are going to do is cost as a percentage of total revenue. We'll use this as a percentage, 1 decimal. Similarly, as I mentioned before, we'll do the formatting once we complete the sheet. So now this we will use the blue color, and after that we'll use the red color, which we 63. I'm just writing any number here when we are looking at the model, when we are analyzing the company, because initially we are just making a structure so that everything gets linked properly, and we could make a complete structure where we could focus on the assumption and the forecasted number later in our course. So let's just say 63%. We'll keep it constant. 63%. So our cost of goods sold would be great. Now we have gross margin as total revenue minus cost of goods sold. So we have the gross profit available with us. Let's look at the Q-on-Q growth. Divide by for this it will be YOY growth. Then we have calculated the YY gross margin growth here. So using the percentage of revenue for cost of goods sold, we have forecasted the gross margin. Now we'll forecast the other line items like SG&A, sales general and marketing expense, as a percentage of revenue. Also the administrative expense. So again we'll use we'll copy this, but we just link it to the revenue. We'll say 6%. In case of, again we'll have to link it to the revenue. Call it 7%, 6.5%. So this is something we should not be forecasting. This would be sum of these 4 quarters and 65%. Then we can forecast this further. So similarly this would be sum of these 4 quarters and so is the administrative expense, and we'll calculate this. So we'll calculate selling and marketing expense as 6% of total revenue. So we have the, similarly we'll calculate the administrative expense, 7% of total revenue. We'll call it 7%. Now this is the total operating expense. This is the sum of selling and marketing expense as well as administrative expense. We'll just add these two columns, these two cells. So we have the total operating expense. Now we'll calculate gross profit. We'll remove this. So the total operating expense. So to calculate the operating profit, we'll divide the total operating expense from the gross profit minus total operating expense. This is going to be our gross operating profit. We'll calculate the Q and Q. We'll just use this formula for Q and Q. Now after calculating, we'll insert a row here. Okay, now we have other income and expense. These are normally if the number is very small, we can just assume it to be zero because it won't make any significant or material change in our forecast or in our final valuation model. Or else if it is a significant number, then we'll go to the financial and the management notes to see what it constitutes and forecast according to that. Because it's a very small number, we'll consider it zero. For this it would be sum of this, then it will be 0 for the. Now finance income, it. Finance income, now it's a very important point to note. I'll tell you finance income. In case of finance income, finance income we can also forecast as a percentage of revenue, but it's more appropriate to forecast finance income as a percentage of cash. So whatever excuse me, whatever finance income we are getting would be through the cash. The company would have kept the cash in the fixed deposit or in the bank account, and that cash must be generating some income for the company, and we would take that into account for in our income statement. So we should be forecasting the finance income as percentage of cash. Similarly, the finance expense should be forecasted as a percentage of debt. We also call it interest expense. So this we would forecast, it would be more appropriate to forecast the interest expense as a percentage of debt, since we know that Infosys do not have any debt in their books, so they won't be having any finance expense, rather they only have finance income, which is the income generated through the cash. But the important point is, important point to note here is, when we are forecasting the finance expense or the finance income, so we need to forecast this would be the percentage of the cash at the starting of the year, or in case of finance expense it would be debt at the starting of the year. So when we forecast, I'll show you here. So this is as a percentage of cash and cash equivalents. So this is we'll just freeze this. Freeze the pane so that we could yeah. So this would be, will only forecasted the yearly number. This finance income would be FY13. So the cash in the starting of FY13 would generate $371 million of finance income. So the cash, what would be the cash at the starting of FY13? This would be the cash at the end of FY12. So let's go to the balance sheet, and this is the cash and cash equivalent. This is the number we have at the end of FY12. So 371, this is 371 divided by balance sheet FY12. Okay, so the income cash is generating is 9.2%. So we'll what would be the similarly we would have so when we'll forecast the balance the cash the balance sheet, when we'll forecast the balance sheet, we would have we'll have to assume this we'll use 9%. So 9% is the, we would assume that is going to be the return on our cash. So we'll call it 9% of cash at the end of FY13. This is the cash at the end of FY13. Okay, so we have this number now with us, and now we have to calculate profit before tax. We'll we'll calculate this number just for call this number as this divide by cash at the sheet. Let's expand this and look at the balance sheet so that we have the quarterly number also. FY 12 and 13. Let's go to the output sheet and we'll look at this quarterly number also. So we have this trend historically. So this would be at the end of FY 12. FY 12 at the end of how much is the cash at the end of Q4 12. This is the cash, and this would be at the end of Q1 2013. Q1 13, our cash has decreased. Okay, so we'll forecast this as we'll call this sum of these 4 quarters, and this would be this divide by cash at the end of 2013. So at the end of 2013, this is the cash. So this number, we'll call it 3%, and this would be 3% of cash at the starting of Q2 at the end of Q2 2014. At the end of Q2 2014. See, so this is how we can forecast this. And to calculate the profit before tax, we'll just subtract the will add the finance income and other income and expense from the operating profit. This now this is the income tax expense. We'll calculate the effective tax rate. Effective tax rate. This we can calculate using income tax expense divided by profit before tax. Now this will keep it at 28%, then 30%. This is sum of these 4. So the tax expense would be 28% of profit before tax. And this would be divided by profit before tax. 28, will keep it at 28% for the time being. And we can also drag this to be we'll link it further, and this is going to be 28% of this. So we have forecasted this. Now to calculate the net profit, it is simply going to be the profit before tax minus the tax, the income tax expense you have paid, Now we can simply calculate the Q&Q profit growth. This is going to be the profit growth. So we'll do just the simple formatting. So we'll keep one row empty. We'll highlight this. We'll make it blue. The only thing now we need to do is just we'll keep this we'll do the basic formatting in case of we'll put the lines across the columns. Right. So this is how we have forecasted the complete income statement. We have the profit before tax up to 2018. We have forecasting as a percentage, and this is the basic formatting we have done. In our next session, we would be talking about balance sheet forecast, and we'll see how to balance the balance sheet so that the total asset comes out equal to the total liabilities and equities. So this is all for today's session. Keep enjoying the course. Thank you.